5 minutes.
Thank you, Mr. Chairman and Mr. Chairman. You mentioned in your opening remarks about financial stability concerns driven by the quest for higher yields and some of the risks that could cause given the low yields in fixed income instruments. Mm-hmm. Has your concern about these financial stability concerns increased recently?
I would say that has increased a bit. We have greatly increased our monitoring and our attention to these issues, and we pay very close attention to essentially all asset classes and all major types of financial institutions, even those we don't regulate. We're trying to ascertain both whether there is a sign of frothiness or bubbles, and moreover, what exposure there is in the sense of high leverage or other kinds of vulnerabilities that would mean that if a frothy asset price were to reverse, what implications would that have for the broader economy? So we're paying close attention to that and doing our best both through monitoring but also through our supervision, regulation, coordination with other agencies and so on to address these problems. Some of these issues were discussed in the FSOC's annual report, which Secretary Lew has been testifying about. So this is an issue. And it's something that we take into account. As we mentioned in the statement, we look at the costs and the efficacy of our program, and I think the most significant cost is probably financial stability concerns. On the other hand, it's a very difficult trade-off because, as I mentioned, a weak economy means low interest rates, which creates some of the same problems, and moreover, a weak economy means worsening credit quality, for example, and that too has financial stability implications. So there are trade-offs and difficult judgments to make, but I just want to assure you that we're quite aware of this issue and watching it very carefully, and it does factor into our thinking about the appropriate amount of accommodation and the appropriate exit strategy.
Speaking of exit strategy, yesterday, Federal Reserve Bank President William Dudley said that the Federal Reserve should consider holding on to mortgage-backed securities until maturity, rather than selling them at whatever point an exit strategy might be necessary. Maybe I read wrong, but I thought I heard in your responses to Chairman Brady's questions that perhaps you agree with that viewpoint, and if so, because when the Fed entered the QE a couple of years ago, that was not the plan for the exit strategy. The plan for the exit strategy was to begin selling these securities at some point. Where are you? Where is the FOMC on this right now?
You're correct that we have not updated the exit strategy we put out 2 years ago, and which included sales of MBS. And we've, as I said, we've not done that yet, and so the committee hasn't officially communicated our plans there. But I will say that we have done a lot of work on this, and I personally believe that we could exit without selling any MBS because most of them will run off in a reasonable period. But that decision has not yet been taken, and we will certainly let people know it when it is taken.
If you do that, aren't you subject to an argument that that's outright monetization, in that debt will have never been sold to the public effectively, that you're increasing the monetary base this way?
No, because monetization means that we permanently finance the government using money. What we plan to do is ultimately to get our balance sheet back down to a more normal level, and in particular to get excess reserves, which are currently nearly $2 trillion, back to a more normal $25 billion or so at some point. Seems like the likely outcome there. And my point is that we can do that by allowing assets, particularly MBS, simply to run off and mature rather than selling them. Either way, it gets them off our balance sheet.
In my final 45 seconds here, Bank of Japan, and yesterday they reiterated their QE, if you will, and there is significant buying. The yen's been depreciating about 5% against the dollar. How do you see this in terms of a potential currency war, the race to the bottom, our QE, their QE? Are all world central banks leading towards trying to war here of depreciating currencies?
The G7 has given a statement with which we agree, which is that monetary policies which are directed primarily at the domestic economy and are not specifically designed to affect relative exchange rates are acceptable, because whatever effect they may have on exchange rates, they also affect domestic demand in Japan, which is good for the global economy because it creates more trade and more activity around the world. So we are supportive of Japan's policies, and I would make two observations. One is that under their current plan, the Japanese Bank of Japan's balance sheet as a share of GDP will be 3 times larger than the Fed's, just to give you a sense of proportion. And secondly, though, that the actions they've taken seem to be having fairly dramatic effects, both on financial markets, but also on, so far as we can tell, on some aspects of the real economy. And I take that as a bit more evidence that these policies do have effects on the economy.
Thank you.
Thank you, Representative.